Good morning. It's Friday, August 4th, and you're listening to the Macrocast. I'm your guest host this week, Stratton Kirton, a partner here at Penta, joined as always by John Fagan and Brendan Walsh from Markets Policy Partners. Today is Jobs Day, but gentlemen, before we get into it, I feel obligated to ask, have either of you been indicted this week for trying to overthrow the government?
Well, I'm
normal Thursday.
Step ahead of the law coming up to the Berkshires. So maybe the indictment papers are resting in my on my front porch at home.
And I guess to be fair, the week's not out yet. Still a couple days left. All right. Well, let's hop in if it works for you guys. I think a little less than an hour ago, we got the latest jobs report, and I can run through some top lines, and then let's dive into it and, tell me, what does it actually mean? Does it change the narrative? What does it mean for the Fed? How have we done versus the rest of the world? Does that work for you?
Love it.
All right. So about 187,000 new jobs in July, just slightly meeting expectations. Unemployment steady at 3.5%. But I think overall, already a pretty strong consensus that, for where we are, this is a good jobs report. Long-term unemployment, pretty steady. Labor force participation rate, pretty steady. Employment population ratio, pretty steady compared to last month. But some big caveats that I think add to the positive news there. If you look back a year ago, we've added more than 3 million people to the labor force. So even though the unemployment rate staying steady, it's staying steady for the right reasons, I guess. And average hourly earnings, 4.4% compared to a year ago. So I'm sure if you're sitting in the White House where inflation rates are now at 3%, you are probably pretty happy. And then otherwise, no real one sector driving the gains, a little bit in healthcare, finance, trades, hospitality, and real estate, and then a little bit of downward revision. But overall, my takeaway is for where we are and where the Fed is, this looks pretty good. What about you guys?
Yeah, this is a Goldilocks report. This is not too hot, not too cold. Coming into it, we had the same replay that we had in at the beginning of July with the June numbers. We had a very robust ADP number, which is the payroll giant, sort of preempts or tries to preempt the non-farm payrolls earlier in the week. And in June, it came out with just this blockbuster number, and then the non-farm payroll was kind of right down the fairway. And we saw something, a lesser version of that this time. ADP was strong, but not so wildly strong as last time. It was up over 300,000 jobs and well over expectations. And so, and we saw this, the Treasury markets really having some pretty chunky sell-offs this week, particularly in the long end of the curve, the duration 10s and 30s getting pressured. So this is a number that looks like kind of a relief, and I think that from the perspective of the Fed's, there's still a lot of communications to be done on this, but the sense that you got from Chair Powell and his press conference really was that the Fed is on hold unless, the burden of proof is kind of on the on inflation, on economic upside surprises to force them to hike again. And absent, significant upside surprises, then they'll probably be sitting on their hands. And this, I think that this report really doesn't change the outlook for the Fed, which is for the Fed to basically be done with the tightening cycle and keeping the settings as they are for the coming quarters.
Brendan, I'm curious if you looked back 3 years ago, like how have we done in the recovery post pandemic?
So, I don't know. I haven't looked at the data, out of whatever 1930, but this, in terms of the jobs added, it's been, the largest, economic expansion in terms of jobs like we've ever had. A lot of that had to do with, people lost their jobs because it got shut down and then you went back to work. So you have to adjust it. But even when you take that out, no one thought that 2023 would be as strong as it has been. And a lot of people still don't accept that it is strong, The surveys are funny. When people ask about the economy, people say that the economy is bad. When they ask about how you're doing, people are very optimistic about their own futures. So it's a weird dynamic that we have. I suppose it's not a great one for Joe Biden because he's not getting a lot of credit for the economy. The only slight caveat that I would put is I've always found that, at the beginning of an economic expansion, the jobs numbers get reported lower, and then in a few months you get very large revisions. At the end of an economic expansion, you start to get negative revisions to the initial print. And the last couple of months we've had negative revisions, so we could be coming to the end of these large numbers. And not that we have to start losing 500,000 jobs, but we could be getting to that point where job creation is kind of flat.
Yeah, that's fair. I mean, and from a political standpoint, to your point about the economy's good, the vibes are bad. I think if you're the Biden administration, the worst possible time for you to start having flat or slightly negative numbers would be going straight into that 2024 buzzsaw.
Yeah, and that's exactly kind of how it would probably be playing out, unfortunately, if you're Joe Biden, that the second half of 2024. Now that we kind of think that we're going to be in a mild recession, but it could be like a long-lasting mild recession where things just kind of stagnate. We're seeing right now, the OPEC, not really OPEC's, but Saudi's efforts to raise oil prices are working. They continued their cuts, and oil prices are going up, and that's flowing through to the gas pump, and that's also at a time where the student loans, people are going to have to start paying their student loans back. So the consumer has been very strong, and a lot of that strength of the consumer has been that you weren't allowed to do things for a year or two, so you're playing catch up. But those animal spirits will kind of be out of the system in 2024. So we could see a more restrained consumer with a less robust jobs market, which kind of results in just kind of a blah economy.
Yeah, and it gets me thinking. I can't imagine, given where the politics are right now in Washington, we're going to see anything approaching economic stimulus in the next year. And if anything,
no, it's impossible, right? Yeah, right. I mean that's our base case, but there's no way with a divided House that we're getting. I suppose you could get tax cuts, maybe.
Well, and then I'm just thinking, actually, probably to your point, even heading in the other direction, right? Like we're past the debt limit standoff, but I think the safe money right now is we're heading into a government shutdown in October. Does that have a huge macroeconomic impact? But in terms of confidence in the economy, it's probably not going to help.
Exactly. And to your point, we're not getting any stimulus. And also, to John's point earlier, the Fed's going to be tougher in terms of cutting rates than they've ever been before. They just fought for a year to regain the market's confidence that they're inflation fighters. So they're not going to immediately return to zero rates as soon as things start to slow. Especially because oil is kind of detached a little bit. So oil prices are going to kind of keep that CPI PCE price index a little higher than it would have been in a normal slowdown in global growth.
Well, and then I feel like I'd be negligent if I didn't bring it up. But adding to it, I have to imagine what we saw from Fitch this week, regardless of where you are on it, is just going to give even more excuse for bringing down overall federal spending. Even if we do get a budget agreement, that we're not likely to spend more. We're going to go even lower than the caps they agreed on.
Yeah, I think whether that really has a political impact, I think remains to be seen. But I think that just to opine a little bit, the Fitch decision, created a lot of head scratching in the financial community. And
why now?
Why now? I mean, you're in a position where they've gotten the debt limit has been kicked forward. It wasn't even a particularly contentious, in the grand scheme of things, it wasn't nearly as bad as
compared to how it was built up. Yeah.
And it's to January 2025. It's been kicked out to the And this is obviously nothing new. This is exactly the same playbook we've seen for 12 years since the 2011 really kicked off this cycle of debt limit fights. The fiscal accounts obviously are not in great shape, not where we want them to be, but incrementally looking better and on a tightening path. That was part of the deal that President Biden struck with the congressional Republicans, and just the overall atmospherics around the decision just are very puzzling. Not a lot of new information, and it's odd. Like S&P's decision back in 2011 was not looked back at, in hindsight, as like a particularly cogent and proper decision. It was generally seen as sort of like gratuitous and an overreaction. And so for Fitch to join them, particularly now at this time, it's a baffler, and it's hard to understand and unpack what's behind it. It's certainly going to give the sort of fiscal hawk crowds a talking point, and another cudgel to beat the White House with. But to be perfectly honest, I think that our perspective on this Fitch thing is it's a capricious decision that it really doesn't give you any new information about what's happening in U.S. fiscal accounts, and should be discounted deeply. The big sell-off in treasuries this week, it's one of these things where if you get a downgrade and treasuries sell off, boy, that doesn't look good. But there were so many other facters. I'd be very hesitant to ascribe any of the price action.
I fully agree with
treasuries
that.
To Fitch. I mean, we've just it was ADP numbers. It was rising inflation break evens. It was an understanding that the Fed is probably going to be done with the tightening cycle, which will tend to elevate the long end of the Treasury yield curve anyway. And I think that that is the dynamic that we're seeing, not some sort of investor reaction to this decision by Fitch.
Got it.
I'm kind of interested to see if this will spur any congressional hearings, because the rating agencies totally lucked out in terms of the 08 mortgage crisis. They rated all this stuff AAA, and it turned out to be junk. And I always thought that they were going to get heavily regulated or through it, and they just kind of skipped through Dodd-Frank, and nothing changed in terms of the way that it's kind of the pay for play model still. I pay Fitch to rate me a AA or whatever. I wonder if this will cause either Congress or the regulators to take a stronger look at the way that the rating agency's business model works, because it's not a clean one.
You know what? I did not have it on my bingo card to rehash that debate from the 08 recession.
I mean, the Treasury Department, their heads must have exploded when they saw that. I mean, it just must have been I can only imagine. I would love to have been a fly on the wall in senior staff to listen to that. It would have been, I think, a scathing. Janet, Secretary Yellen's commentary, she's very even-handed and
yes.
But behind her measured words of calling it like peculiar and outdated and that sort of stuff. I'm sure some spicier characterizations thrown around within 1500 Pennsylvania.
All right, what about any other central bank decisions from around the world? I think we had Bank of England this week, is that right?
Yeah, they raised 25 basis points. That's what the market had priced in, but there was, there was thoughts that they could go 50, as their inflation has been above expectations, but also kind of above Europe and the U.S. But they delivered the 25 and kind of left it on the table. But over in Australia, the RBA, the Reserve Bank of Australia, decided to hold, which was a big surprise, where they're kind of going surprise hold, surprise hike, surprise hold. So they're kind of leading the market in terms of surprising, in terms of their decisions.
All right, gentlemen. One thing I wanted to dive into is, related to some of the things Brendan had brought up earlier with oil markets. But one of the big drivers is what we're seeing out of Asia, or I guess lack of a driver out of Asia, and particularly China. I feel like there's been a little bit of a drip over the last few months, particularly since March. But then a lot of numbers coming out really talking about what might be some underlying weaknesses in the Chinese economy. Some things that have stood out to me is one, I think we're seeing some more data on home sales numbers on some of their largest real estate developers who are not in bankruptcy, trying to float new shares and then withdrawing them. And then lots of commentary, maybe some of it driven by, I don't know if you had a chance to read Adam Posen's great piece in Foreign Affairs, really a long form read on the status of the Chinese economy right now, on youth unemployment, manufacturing is declining, exports are declining. So I guess my question here is,
especially the youth unemployment. That's troubling if you're, a communist dictatorship.
Wow. And I mean, the ranges being thrown around are a floor of 20% and a high of maybe 50%.
Yeah, that's scary.
Yeah. Even if you're in between there, you're not in a good place.
Yeah. No.
So I guess the question is, what are you guys thinking about when it comes to China right now, where we are? We're 8 months in. We were supposed to have a huge uplift after the end of zero COVID. And we saw a little bump at the beginning of the year, but it feels like it's virtually flat now. What's going on and what does it mean for the rest of us?
Yeah, John has a 20-year history of, watching China as an economist and an investor. So let's throw this one to him.
Yeah, China has obviously, just taking a step back and looking at the commentary on China, particularly like from the US, you get a lot of clusters around. Traditionally, you get a lot of clusters around the polls. You always had, the extremes, the very bullish, China crowd, and then the extremely bearish sort of Kyle Bass. China is, one week away from a blow up. And everybody seems to talk in exclamation points when it comes to China. We sort of made when we were back at the hedge fund, our strategy was really to try to take the middle, not marry one particular view or the other, but play a very tactical role. We thought that, China would be after the 2009 massive fiscal stimulus that they enacted, which some people say saved the world economy way back then. Well, it's left them. That was just the beginning of sort of the legacy debt problems. They essentially used their banks to make these fiscal, whether it's state banks, but they also pressed the private sector banks to make loans. This idea is basically predicated on the idea that, if you're going to do a massive fiscal stimulus through kind of a state-led banking system, the bankers themselves are going to have a better track record of making those investment decisions rather than, government bureaucrats. So you can kind of see the logic that they went with, but essentially it sort of trashed their banking system and left them with a bunch of losses unrealized on their balance sheet. And, in the successive years, they had slowdowns that they would respond with, lesser but similar kinds of big fiscal stimulus. You would see it in the lending numbers beef up. We're getting loan numbers next week, which is going to be, indicative of how much the newly pro-growth posture from Beijing is really translating into that credit extension from the banking system. But, this is something that, as I said, they've done this successively again and again and again. They've tried to wean themselves off of it. They've tried to find other sources of, growth, productivity, and economic vitality. But, they just keep defaulting back to, putting more banks, evergreening those loans, pushing bank lending into property, and these, massive unrealized losses. The central government is just deeply unwilling to fiscalize those losses. When you look at the central government's fiscal accounts, they just don't have a very big debt to GDP ratio. And so there's a sense that the government could eventually take on a lot of these loans, but none of these outcomes, whether they just kind of continue to do what they're doing now and have done for the past few years, which is, push the same old kind of just enough stimulus to keep four wheels out of the ditch and keep the show on the road and, try to catch the next uplift cycle and the next demand cycle from the West and surf that. That's been the game that they've been playing rather than actually, rolling up their sleeves, doing the hard work, and allocating the losses from these big projects and property boondoggles that absorbed so much of the capital over the successive waves of stimulus before. There just doesn't seem to be any new thinking. All of this latest, after COVID zero, they announced a 16-point property support plan. Our view on that was, look, you can ride an announcement-driven pop in the Shanghai Composite or one of the other, Hong Kong, Chinese listed Hong Kong companies, Hong Kong listed Chinese companies, et cetera. But, get out, get out quickly. This is a dead money market. It hasn't gone anywhere for like ages. And it's going to pop and drop, on these stimulus announcements when it comes clear that those, there's just really no traction there until they get serious about really going in and expunging some of these legacy debts, taking some real losses, and making these hard decisions about their economy. Well, we're going to see more of the same, I think, and it's gone on so long, as you say. The rot has really spread to a degree that we are seeing really, those red flashing warning signs on the dashboard, like youth unemployment. Is it all going to collapse? The Chinese government has so much ability to translate policy decisions into action and throw plenty of, there's still plenty of money to throw behind it. So they can head off a lot of systemic crises. And so if you're going to kind of choose an outcome, is it going to be a cathartic 2008 style, Kyle Bass's pipe dream of China's economy collapsing? Seems less likely than, they just kind of continue to slouch along in its lower and lower productivity environment, losing manufacturing to overseas, having, consumer vitality sapped by, the unbalanced kind of economy that they're running, and having those, essentially the property market is just big flaming barrels that they keep throwing money into to to burn. So that's more the ice rather than the fire outcome. And we think that is more likely to continue. So all the stimulus talk, it may give you a little pop in the markets, but it's a rental, not a stock it's not a stock market to own.
Well, I'm curious if I can just double click on the rental thing for a second, because I'm probably going to get my timelines mixed up. But thinking about, I saw the 16-point plan, but there's been vacillation even on that in the last 8 months, haven't there? Because then there was a crackdown on speculation, but then a perceived pullback because they're worried about the housing market. So it seems like even when there is a pop, that there's not, at least right now, long-term consistency. And maybe that's because they're, flailing might be too strong of a word, but flailing to look for something.
Yeah, exactly. And that really speaks to the conundrum they're in. They want property markets to, they want to avoid a worst case outcome in property markets, but what they don't want to do is reinflate a property bubble. And so they're trying to do both. It's really hard to have both of those goals, those competing goals in mind, and particularly under the conditions that sector is in. So yeah, it's an unenviable situation to be in.
Would you say they're looking for a soft landing in the property market?
I think that they're the whatever floor they're going to land on is so far below them. There's just an enormous amount of downside and losses that have to be realized, in this sector to really sort of clear the market.
Yeah.
And market clearing is not an easy process. And the Chinese government, they're not in a position where they want to take a lot of pain. Obviously Xi Jinping has been trying to, and this was, again, a thesis that we developed way back in our hedge fund days. Xi Jinping is trying to diversify the sources of legitimacy away from economic growth to more of that nationalist rah-rah, that was that militaristic and wolf warrior kind of diplomacy stuff, more assertive China, and try to gain legitimacy and create that alternate source of legitimacy from the people, rather than what the previous administrations had done, which was essentially gain all of their legitimacy from growing the economic pie and helping people's lives improve. But under the circumstances, Chinese growth rates are never going to be what they were in that heady period where they were really playing catch up. And so, Xi Jinping has obviously gone pretty far down the road on that front. But is it enough to create a stable kind of political environment for the long term now that he's president for life?
All right. Well, so Brendan, one of the things you touched on that is, definitely driven at least in part by the weak demand out of China is what's happening in the oil markets. This is my favorite topic, but, earlier this year we saw prices relatively depressed and we've seen OPEC plus responding. But what's happening now? There've been, I think, particularly in the last month, big movements.
Yeah, so Saudi kind of did a unilateral surprise cut to their production. We've had a few other pullbacks for other reasons. Libya had a shutdown at one of their key ports, and Nigeria's had some issues. And also Russia, for whatever reason, has also pulled back a little bit. So, the amount of supply coming to the market has dropped fairly precipitously in the last month. Saudi also just yesterday announced that they're going to, maintain this, pullback in production for another month. And finally, the oil markets are reacting to it. For 3-4 months, they did cuts and prices. It was range bound, but oil was in terms of Brent was in the 70 to 75 range, and WTI $5 or $6 lower than that.
Mm-hmm.
Now the world is kind of paying attention that the supply is less, and also especially in the United States, the demand has been pretty strong. We had the largest. So EIA does weekly crude oil inventories, and last week we had the largest draw ever. We thought it would be 1.3 million barrels, and it was like 17 million barrels. So that's how markets work. Supply demand, and supply is less and demand is more, and oil prices are going up, and that's leaking through to the pump. And gas prices have been up for the last 2 weeks. About 20 cents.
Yeah, from a policymaker perspective, right? The Strategic Petroleum Reserve, obviously,
exactly.
The Biden administration has said that they were going to fill up and they would do it when prices were under 80. They were under 80 for a really long period of time, and the SPR wasn't really topping up. So that seems to me to be a sort of a commodity trading desks miss the bottom all the time, and to the extent that it's not easy to get it. You're always playing for those lower prices, or who knows what was behind the decision to wait. But it seems like at least in the near term that OPEC and Saudi have really gotten the market's attention when it comes to supply constraints, and just how much willingness they have, at least in Saudi, to unilaterally shoulder those. And OPEC Plus has really hung together in these very challenging times. So, our base case is that as Brendan said, that the economy is going to slow down through the end of the year. The U.S. economy is going to slow, not like fall off the cliff. And we don't think that the Chinese economy is great shakes, but so the White House may get their chance to buy below 80 again, sort of back half of this year, early next year kind of time frame. But they should be pretty opportunistic, I think. The OPEC is very determined to put a floor under this market at 80, and the White House should totally respect that.
All right, gentlemen. Well, it's August in DC, which means for us it is quiet. But what are you looking ahead to for next week?
So next week we get the inflation data out of the U.S., the CPI and the PPI. So the next Fed meeting, as John said, is not till September. So we have a lot of data that's going to come. And Chair Powell has said, we're going to be data dependent. So these data points really matter. We had a okay jobs number, as we said, but I think the ones that really, really matter are that the Fed wants to see continued, drops in both the headline and the core inflation rate.
Yeah,
but as we said, the headline might be up a little bit, because gas prices are going up. But core can still keep coming down as the housing data, which is slowing at a lagged pace, starts to flow into the data.
Yeah, I think Brendan makes a really key point here, which is now at this point in the tightening cycle, the Fed is not tightening to, because job growth is even if they're not trying to slow the economy down. Right, they're trying to make sure that inflation is tame, and that really, I think, is the message that we've gotten from Fed Chair Powell. Their reporters were always trying to draw them out. What if we keep getting strong jobs numbers? And Chair Powell's response is essentially like, I'm not raising interest rates to crush the labor market. I'm raising interest rates to crush inflation. And if that takes, denting the labor market, that's what we think it's going to take. So we expect that to happen. But, that's not the bullseye that they're shooting at. They're shooting at CPI. And so that it's going to be a very important number, obviously, next week. But, indicators are pointing in the right direction. We're also done with earnings season pretty much. I mean, we've got UPS and Disney next week, but most of the earnings are over and out. We saw sort of the last big hurrah was Amazon and Apple last night, and kind of in keeping with the trend of this second quarter earnings reporting season, it was a split decision. Amazon looked great, and cost control and growth. Apple looked a little less great. Third straight quarter of sales declines, a little softer, disappointing in the iPhone department, and so those stocks are having a divergent reaction, and that's really been the tale of kind of one step forward, one step back, maybe not two steps back, but we've seen real mixed bag out of earnings, and that's when expectations were pretty low, which usually allows upside surprises to predominate. But in this case, we've particularly with tech, it's been a mixed bag, and markets have meandered rather than trended since the beginning of earnings season in the middle of July.
All right. Well, everyone, thank you for listening to the Macrocast. I'm Stratton Kirton with Penta, and thanks to John and Brendan of Markets Policy Partners for having me as a guest host, and have a great weekend and a good August.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.